Hello, everyone, and welcome to MSUFCU's Financial Education Seminar Series. We appreciate you all joining us this afternoon. These presentations were created with you in mind with the intention to give financial education on a number of relatable topics to help expand your knowledge of finances. We have a number of diverse presentations planned for you this year, and you can explore and register for them by visiting us at msufcu.org/events. Today's event is being recorded, and you can rewatch or share any recorded presentations by going to youtube.com/MSUFCU and then selecting seminar series from those playlist options. We will have time after the presentation to address any questions that you've submitted through the Q&A. So there should be a little Q&A function at the bottom of your Zoom screen that you can use to submit those questions. So I am Therese Bacon. I'm a financial educator with MSUFCU, and today I'll be presenting on the topic of credit repair. So let's go ahead and jump right in. We know that credit can feel overwhelming or even frustrating, especially when you're working to improve it. But today's session is designed to break those things down in a way that's approachable, empowering, and actionable. We'll start with a brief overview of what goes into your credit score, including the common things that can negatively impact it. From there, we'll walk through the most effective steps in the credit repair process, while also acknowledging that everyone's financial journey is different. You'll hear about various options and resources that may be available to you depending on your situation, and we'll end with a few key takeaways to help you feel more confident as you begin or continue your own credit repair path. So whether you're just starting to learn about credit or actively working to improve yours, there is something here for you today. Let's go ahead and get started here. So we'll start with the definition of credit. So this is a contract agreement in which a borrower receives a sum of money or something of value and repays the lender at a later date, generally with interest assessed. And let's take a moment to also clarify the difference between your credit report and your credit score, since they're closely related, but not really the same thing. So your credit report is a detailed history of how you've used credit over time. So it includes things like credit cards, loans, payment history, balances, maybe public records like a bankruptcy or a collection account. So you can kind of think of the report as your financial resume. And then your credit score, on the other hand, is that three-digit number, usually between 300 and 850, that's calculated based on the information in that credit report. So it's kind of like a grade that's going to tell lenders how likely you are to repay your debts. So your credit report is the actual data, and then your credit score is kind of the summary of that data. The better your report looks, the better your score is likely to be. And then some things that are not going to be included on the report are things like race, religion, gender, marital status, and actually income. Those are all things that are going to never be included on your credit report. Now we'll take a closer look at what actually makes up your credit score. So many people know that they have a score, but not everyone knows how it's calculated or what you can actually do to influence your score. Your credit score is based on several key factors that we have listed here, and really understanding each one of them on its own is kind of important if you're working to improve or maintain good credit. So on this slide, we'll walk through those main components, which all kind of work together to give you a picture of how you manage debt and how you manage your financial responsibilities. So let's start with payment history. This, as you can see by the graph here, is the most important factor. So it's going to show whether you've paid past credit accounts on time. Even one late payment can negatively impact your score. Next, we have depth and type of credit. So this is kind of based on the length of your credit, firstly. So how long you've had credit, the longer the better. And also it takes into account that healthy mix of different types of credit accounts. So you have credit cards, you have auto loans, maybe an unsecured signature loan, mortgage, student loans, things like that. So that healthy mix of different types of credit is also going to help your score. It's important to show lenders that you can manage different types of credit responsibly. Next is credit utilization. So this is the percentage of your available credit that you're actually using. So ideally, you want to keep that utilization rate below 30% to show that you're using your credit responsibly. Once you carry balances that are above that 30% utilization and you're carrying those month over month over month, it is going to impact your score a little more negatively from what we see. Also, carrying those high balances month over month is going to like kind of signal to lenders that you are kind of risky, that you might not be able to make those payments on time as they're, piling up like that. Next, we have balances. So these are like your current balances, how much debt you actually owe across all of your accounts right now. Those high balances, like we talked about, especially across multiple accounts, are going to lower your score. Then we have recent credit. So opening several accounts or having those multiple hard inquiries because you're applying for multiple accounts, having those in a short period of time is going to be a red flag to lenders. They're going to see it as a little more risky behavior or a sign that you're in some sort of financial stress at that time. And then we have that available credit, which kind of plays back into that utilization. So the total credit that's available to you compared to what you're actually using. And having more unused credit is going to help boost your score over time. So steps to begin to repair your credit. So you want to start by educating yourself, which is why you're here today. So you're taking a good first step. You want to start by learning what impacts your credit and how the scoring system actually works, right? So the more you know, the more confidently you can take action. Then you want to review your report. You can request your report for free from annualcreditreport.com. We'll show you that in a little more detail in an upcoming slide. But on that report, in that review of it, you want to look for any errors or outdated info, any possible suspicious activity, since we all know that identity theft is, a very common thing these days. So those are all things that might hurt your score that you might be able to resolve on your own to help improve your credit right away. You can access all three credit bureaus' reports through that annualcreditreport.com. And it's important to really review all those. You might think lenders use Experian more than TransUnion or something like that. But really, it's good to look at all of them because some lenders only report to certain credit bureaus. So it'll kind of help give you a full picture if you're reviewing all three bureaus. And then do the math. So you want to take note of those balances, due dates, and interest rates. That's very important over time. You want to calculate that credit utilization since we know that that is a big factor into what makes up your score, that how much you're using versus how much available credit you have. That's also going to help you prioritize which accounts or habits you might need to address first. And then make the call. So you want to contact those creditors or lenders that maybe collection accounts that you see reporting on your credit, or if you have anything that's just, maybe a little delayed in payment but hasn't gone to collections yet, maybe address those first and call those lenders first. You can ask about options like payment plans or maybe, adjusting a balance type, a settlement type of situation. So really being proactive about it yourself is going to show that lender that you are taking responsibility, even if, you did have a setback of some sort, and they may be a little more willing to work with you for some different resolutions. On this slide, we're looking at some of the most common items that can drag down your credit score. So first, credit cards are a big one. When balances are too high compared to your credit limit, that utilization again, or if you open too many accounts in a short time, it can hurt that credit utilization ratio. Then payments are another critical factor. So your payment history really shows those lenders how reliable you are at paying back what you owe. So those late or missed payments, even just one, sometimes we've seen that affect credit scores by up to 100 points, especially if it's something like a mortgage versus just, paying on a store card or something like that. They do kind of weigh differently. Then you have those derogatory items, which include things like collections, charge-offs, maybe bankruptcies or foreclosures. So those are considered major negative marks and they can have long-term effects on your credit standing. And finally, inaccurate information can sometimes appear on your report. So things like wrong account balances or incorrect payment statuses or accounts that don't belong to you. Those errors can unfairly lower your score, which is important to, for a reason to review your credit regularly and dispute any of those inaccuracies that you might find. Understanding these factors can help you identify problem areas and maybe help you identify those steps that you might need to take first to improve and protect your credit. Now let's take a moment to recognize your personal money cycle, how money tends to flow in and out of your life. Identifying that cycle and where you're at right now can help you better understand your financial habits and where there might be some room for improvement. So let's talk about the first cycle: earn, spend, borrow, spend. So in this cycle, you earn money, you spend it, and then when that income runs out, you're forced to borrow. So this means, using your credit cards or maybe getting that payday loan, right? Because then you need to continue spending, right? So this is a pretty negative cycle, right? One that I've definitely been in, and had to kind of work my way up the ladder to get to that more positive cycle we see at the end. But let's talk about next the earn, spend. So with earn, spend, every paycheck is being entirely spent before the next one arrives. So you're not borrowing per se, but you're also not able to save any money because you're spending it all. You're living paycheck to paycheck, right? So that does leave you vulnerable, especially if you have a financial emergency of some sort arise, because you're not in a place where you're going to be able to, mend that without having to take out a high interest loan or use credit cards. Then we have the earn, spend, save cycle. So this is where you spend first and save whatever is left over. So yes, savings does happen from time to time in this cycle, but it's not very consistent or planned. And really, if you are working towards some sort of, financial goal or a big purchase that you want to make, the earn, spend, save cycle isn't really going to prioritize that and help you reach those long-term goals. So finally, the healthier cycle that we see here is earn, save, spend. So here your savings is happening first. You're prioritizing setting aside that portion of your income before you start spending. This approach is going to help you build financial security and prepare you for the future needs or those unexpected emergency expenses that we all know do arise. So as I talked about before, that annualcreditreport.com, this is really one of the most important steps you can take in managing your credit, is really regularly reviewing your reports. So like I said, you're entitled to that free credit report from each of the 3 bureaus, as you see on that website example there. And actually, since the pandemic, they've increased it to where you can get free weekly reports. So definitely check that out if you haven't, annualcreditreport.com, to really see, what's actually the data that's on each of those reports. I know a lot of times if you do have a bank account somewhere or loans with someone or a credit account, they give you that free credit score, access. But this is really digging a little bit deeper and seeing the data that's reporting on your credit report. When you review your report, you want to check for those inaccuracies. Make sure all your personal details listed are correct, that any of the open accounts that are listed are correct. Payment history, if you've always paid something on time, but you're seeing that it was reported late at some point, look into that, because that could be bringing down your credit score by quite a bit, and it's inaccurate. So those errors can definitely happen, but if they go unnoticed, they can drag your score down over time. So catching and disputing those inaccuracies earlier on are going to give you that chance to correct mistakes before they can cause bigger problems. And then let's take a moment to talk about derogatory information. So this is going to refer to the negative marks that appear on your credit report when payments aren't made as agreed. One of the most common questions people have is, how long does this derogatory information stay on my report? So a lot of these items will stay on your report for 7 years. So any of those late payments that were made, collection accounts, charged off credit cards, foreclosures, and Chapter 13 bankruptcy is going to stay on your report for up to 7 years after the bankruptcy is finalized. And then Chapter 7 bankruptcy can stay on your report for up to 10 years. You also have those hard inquiries. So anytime you apply for credit at all, there's going to be an inquiry on your report. And if you do, monitor your credit score regularly, you might see that, after you applied for a new loan or credit card, that you noticed your score tick down a couple notches. So those hard inquiries do stay on your report for up to 2 years, but they usually stop impacting your score as much after about 12 months. But you still don't want to have, a lot of hard inquiries showing within that 2 year period. Sometimes it is a little less um, effect on your credit if they see that it's all from like auto dealerships. Maybe you were shopping around for a new auto loan or a new mortgage. So if there is multiple credit pulls from, that same type of industry and those lenders, the credit bureaus have made it to where those are a little less impactful to your score negatively. So there's also some facts about derogatory items that many people don't realize. So even after the negative item falls off your credit report, lenders still have the right to ask you honestly and openly about your past credit behavior. So it's best to be honest because they might be seeing something on there that you thought wasn't showing anymore or something like that. Also, even after those I'm sorry, paying off a collection account also. So that doesn't automatically remove it from your credit report. So it will show that it's paid and that there's a zero balance, but it's still gonna be on there for sometimes up to 7 years. So sometimes this can be, a more positive thing when lenders are actually looking at your report because then they can see that, you did have something that was delinquent. You took the initiative to get that paid off. So that, will look good and it's going to help your credit score, tick up over time. So pretty much key takeaway here, those derogatory items can have a long lasting impact, but they're not going to last forever. And as time passes, their impact on your score is going to gradually lessen, especially if you're building those positive credit habits in the meantime, making those on time payments, keeping your utilization below 30%. So that, along with, taking care of those derogatory items, is really going to help your credit in the end. When you review your credit report, it's not just about looking for errors. It's also a great time to take inventory of how well you're managing each of the major credit factors that we talked about. So let's quickly walk through them again. Payment history, like we talked about, most important factor. Are you making payments on time? Even that one one late payment can affect your score pretty big. So keep an eye on that. Be consistent. Even if you can only make the minimum payment, make sure you're making that minimum payment by the due date. Utilization, those available credit balances, keep that under 30%, like we talked about, or lower if possible. The lower that is, the higher your score will be. Recent credit, so this includes any, inquiries or new accounts. So too many of those new credit applications in a short period of time can signal risk to lenders when they're looking at your application. And then depth of credit, so that credit mix, right? How many types of accounts do you have? Do you only have credit card accounts, or do you have a credit card, auto loan, mortgage, student loans, things like that? That good healthy mix is going to show those lenders that you are responsible with different types of credit. As you review your report, think about each of those areas and maybe, dwell on, are there strengths that you have that you can build on? Are there any weak spots that need more attention? Taking inventory regularly is going to help you stay on top of your credit health and help you make more informed decisions moving forward. This step is all about being intentional. So looking at your credit situation and really doing the math to decide where to focus your efforts. So you want to start by asking yourself, what items have the highest interest rates? So these are typically credit cards or payday loans that will carry those higher interest rates. The higher the interest rate, that means the more money that you're paying to that lender over time. So focusing on paying down those balances first can save you a lot of money and help improve your credit utilization. Next, you want to consider what items are the most severe. Some negative items carry more weight than others. Like I said before, that missed mortgage payment or a collection account is generally going to be more serious than a small late payment on a store card. So prioritizing the most severe items can make a bigger impact on your credit health. Then ask yourself, what options do I have? So this might include setting up payment plans, negotiating settlements with these lenders, or possibly even, working with a credit counseling agency. So explore those options and really choose the best path that's going to work for your situation. And finally, how long will those items stay on my report? So knowing that timeline does help you to stay more realistic about, what's going to help improve your credit quickly and what's going to take some time to resolve itself. Some of those items will naturally fall off your report after a certain number of years, and others, might be having more impact in which you'll want to address those sooner. By taking that step back and doing this kind of analysis, you can really approach credit repair with a clear mind, a clear plan, and focus your energy where it's going to make the biggest difference first. Let's next talk about some of the ways you can take control and resolve debt on your own without needing to hire possibly, an expensive third-party service. So first, start with those disputes. If you notice any errors on your credit report, like accounts that don't belong to you, incorrect balances, inaccurate payment history, you have the right to dispute that directly with the credit bureau. And if they can't, verify that the information that they're reporting is correct, then they, are legally they legally have to remove that from your report. So sometimes that, even those mistakes being removed can help, immediately help your credit score to go up. Next, you want to consider payment plans. So many creditors are willing to work with you if you take that proactive step and reach out to them. Setting up a payment plan can help you catch up on those missed payments, hopefully avoid getting sent to collections, and show lenders that you're taking responsibility. Just make sure you also get any of those agreements in writing if you do set up a payment plan. Very important to get that in writing in case anything comes up in the future. Lastly, there is debt settlement. So this involves negotiating with creditors to accept a lump sum payment that's less than the full amount that you actually owe them. So this can reduce your total debt burden, that you owe, but also can sometimes have a negative impact on your credit at first. So debt settlement, it may be an option when your debts are significantly past due, or just, other solutions aren't going to be possible for you. So definitely weigh the pros and cons when it comes to debt settlement. Make sure you know exactly what you're agreeing to with some of these companies before you really move forward. So the key message here is that you have options, and taking action directly with your creditors or the credit bureaus can often be faster, more effective, and definitely less expensive than hiring outside companies to do it for you. Now let's shift gears and talk about how you can actually let credit help you. And one of the most accessible tools for that is a credit card. So, really, the fact is, credit cards are the only way to actively build your credit history without paying a dime, without paying any interest if you use them correctly. So, here's how. Use your card for small, regular purchases. So, that add one bill to a card. So, these are things that you would normally buy anyway, like gas or groceries. You want to make sure to pay the balance in full each month by that due date. And when you pay in full, you're avoiding getting accrued any interest on that balance. And you're still building that positive payment history and showing responsible use of your credit and credit utilization. So this consistent activity is going to help strengthen two major credit factors that we talked about, right? Payment history and utilization. And as you continue to use and pay your card responsibly, lenders are going to consider you a lower risk, which can gradually improve your credit score over time. The key is to treat your credit card like a tool for building credit, not just as extra spending money, right? Hopefully, with this approach, you can take advantage of the benefits of credit without the cost of interest or carrying, debt. When you're just starting out or when you're just in the process of starting to rebuild, it can feel challenging to get approved for credit or a loan. So two common ways to establish credit or help improve your credit standing with a little help from others are by using a cosigner or becoming an authorized user. So first, let's talk about cosigner. This is someone who's usually a parent, relative, or a trusted friend who actually applies for credit jointly with you. So their stronger credit history is actually helping you get approved for a loan or credit card that you might not qualify for on your own. But keep in mind, both of you are equally responsible for making those payments. And if payments are missed, it's going to hurt both of your credit standing. So a cosigner is essentially lending you their credit reputation to help you build your own. The second option is becoming an authorized user on somebody else's credit card. So in this case, you're added to an existing credit card account, and that full account history, including all their nice positive on-time payments and that large credit limit possibly, are going to then start being reported to your credit. So you don't even really need to use the card for it to help your credit. As long as the primary card holder is using it responsibly, it's going to end up having that positive impact on your credit. So those are, kind of low risk ways to start rebuilding credit without taking on that debt yourself. Both of those options can really give you that valuable head start, but use them wisely, keep making your on-time payments, and really gradually work towards being able to manage that credit fully on your own. Once you've established credit and start using it, managing debt becomes the next big focus. So let's talk about that. So when it comes to paying off debt, having a strategy can make the process feel much more manageable. Two of the most popular payment methods that we talk about are snowball and avalanche. So let's start with snowball method. So with this approach, you list your debts from the smallest balance to the largest, regardless of the interest rate. You focus on paying as much as possible towards the smallest debt while making minimum payments on the rest. Once the smallest debt is paid off, you move on to that next smallest debt, and so on. So the snowball method really gives you those quick wins early on, which can help you build that momentum, help you stay motivated as you kind of tick those off the list and eliminate those debts one by one. Now, the avalanche method takes a slightly different approach. So here you're going to focus on the debts with the highest interest rates first, while still making those minimum payments on the rest of your debt. This method saves you the most money in interest over time because you're targeting the most expensive debts first. So it might take a little longer to see that first payoff, especially if you're carrying, a high balance on a high interest card. But financially, it is the most efficient money wise. You're going to be saving the most money in the shortest period of time. So there's no one size fits all answer. Kind of depends on your personal goals and, your personal motivation style for which one you might want to choose. And I personally am one of those people that likes that emotional boost of the snowball method and being able to, cross that off my list of debts that I owe. But other people, money comes first. They want to save the most money that they can. So choosing the avalanche method may work best for them. So just make sure you stick with a plan that's going to work for you, and try to be consistent with that. Of course, you don't have to manage all this on your own. There are trusted resources available to you to kind of help guide you through the process. So one of them that we use very often that we refer to is Green Path Financial Wellness. They offer really personalized support and different tools to help really create that plan that works best for you. When it comes to debt repayment, GreenPath can offer that personalized budget counseling, debt management plans that can really simplify your payments by combining multiple debts into one monthly payment. Often they're able to, work out reduced interest rates with the creditors. So definitely check into that if you are in a place where you think, a debt management plan might be your next step. And then as far as rebuilding credit, GreenPath can offer, that walkthrough of your credit report, understanding what's impacting your score, sharing those strategies to build that positive credit history, how to handle disputes and avoid those common pitfalls that come along with credit rebuilding. And they just have a lot of really good education on their website as well. They've been a long-time partner of MSUFCU. They work with a lot of our members one-on-one to provide that, low cost or free financial counseling services. So they really want to help empower you, not just sell products. So you might want to check them out too. They do have a, free first consultation call if you want to call that 800 number and check out what they could offer you. As we wrap up here, there are some important tips to keep in mind as you work on improving and maintaining your credit. So you're probably sick of me talking about payment history, but first off, make those payments on time and keep accounts in good standing. Payment history is that most important factor in your credit score. So even if you can only make that minimum payment, staying current is going to help protect where your score is at. Second, don't be discouraged by setbacks. Credit repair and debt repayment just take time. There may be bumps along the way, but staying consistent and focused on your long-term goals is going to make that difference over time. Third, document all the steps that you've taken to dispute any accounts or documentation you've received about payment plans. So keeping those clear records and how you've communicated with your creditors is going to help protect you or help you out if you need to escalate anything, a dispute or whatnot. And finally, continue to monitor your credit report and the information on it. Regularly review the report with all three bureaus so you can catch any mistakes early and so you can track your progress and stay motivated as you see those positive changes. These small but steady habits can really make a big impact on your credit health over time. So remember, credit repair is a journey. Every positive step you take, no matter how small it is going to be a step forward. The good news is you don't have to be perfect. You just need to stay consistent and keep moving in the right direction. Thank you all for joining me today. I'll wait a couple minutes if you guys do have any questions to submit. I'd love to help answer those. And also, I wanted to share here some upcoming seminar series events. So we have Financially Fit Female. I don't know if any of you attended last week's session with Caitlin Falensky about the psychology of money, but she will be presenting with us again on Wednesday, July 9th in the evening there, talking about Financially Fit Female. So really, this is for anyone. I'm sure there's going to be helpful tips for all people. But this one is focusing just on women because, statistically, women do make less because they live longer than men, they earn less income, they take more time off work to care for children or aging parents. And all those things can kind of be detractors from their financial future. So she just helps us kind of see some, proactive things we can do, which is really more than just balancing a budget and creating a financial plan. It's really just appreciating the role that money takes in your life and its purpose and how you can invest more in yourself. So that will be Financially Fit Female. And then we have a couple more in the following weeks of July. So you can feel free to register for those at msufcu.org/events. All right, so that is all I have. Oh, let's see, we did have a question come through. I have good credit, but I'm concerned about my current debt levels. Can GreenPath help me with getting lower interest rates or consolidating my debts even with a good credit score? Yeah, so I've been in this situation too where like I was able to keep making all my monthly payments, but I was carrying those higher debt amounts. And unfortunately, I mean, yes, you can definitely call them, but a lot of times creditors unfortunately don't want to possibly lower rate or things like that until you're delinquent, unfortunately. So it's still worth a try. You can always call your creditor directly and see if there's anything that they can do for you as far as that goes. That's what I would suggest really first is just you calling your creditor directly and seeing, what options they might have or what you might be, some sort of, adjustment that you might be able to make. But also, yes, check out GreenPath's website. They definitely have a ton of resources that you can just access yourself on their website. But definitely, if you call them, they can tell you if that would be an option as far as lowering interest rates. But unfortunately, from what I've seen, a lot of times until, the account has gone derogatory and is being reported late, that's the only time that the creditors are willing to kind of work with you, unfortunately. So, but definitely, using that avalanche or snowball method to try to get those balances down is going to be another good first step. All right. And then another question here. I have 2 teenagers who are asking about getting their credit rolling. Can you add them as authorized user on a credit card at ages 16 and 17? And the answer is yes. So this is something that I was able to do with my children. Well, once I got my credit in order when they were, young adults, I was able to then add them as an authorized user onto my cards. I did this when one of them was 13 and the other one was 15 when I first added them. But yes, then once they turned 18, all of that credit history that had been built up, that good history, good utilization, all of that automatically is getting reported on their credit report. So, my daughter and son, they both had to get an auto loan shortly after their credit was established at age 18. And thankfully, because of me being proactive and adding them as authorized users, they had really good credit scores and were able to get really good rates on their auto loan. So yes, that is definitely an option and you can add an authorized user at any age. So definitely something to check out if you know that you've handled your credit well and that's a good option and that you can do that. If you do have derogatory things that you're still working out on your credit, it might not be the best to add somebody as an authorized user because all of that will be reported to theirs. But if you're in the place where you have very positive credit history, then yes, adding a minor as an authorized user can be very helpful for their future. Definitely have seen that firsthand. All right. Well, thank you all for attending. When you close out of the Zoom, there will be a quick little survey that pops up so you can give me feedback on how I did today and also feedback on what you'd like to see in the future from seminar series. So we always look forward to reading those. So you can scan that QR code or you can just close out of the Zoom and the link will pop up to take that survey. So thank you so much for being here with us and we hope to see you again at another seminar series event soon. Goodbye, everyone.